Good afternoon, everyone, and thank you for joining this presentation. My name is Rafael Ojina-Marzis, and I'm the International Economist at Bank J. Safra Sarasin. I will start this presentation by giving you an overview of how I see the world economy developing over the next 12 to 18 months. And then I will spend some time detailing what these views mean for our investment recommendations. The short-term outlook for the global economy remains in large part driven by the development of the pandemic and the ongoing vaccination rollout. As we all know, the new variants of the virus and the slow vaccination campaign in the EU and Switzerland forced government to lengthen or tighten restrictions on mobility during the first quarter of the year. And you can see that on the left-hand side of that slide. Still, though mobility remains depressed compared to pre-pandemic levels, it actually improved throughout the quarter, suggesting that economies and people have increasingly learned to live with the virus. In the US, where the rollout of vaccine has been impressive and restrictions started to be lifted already earlier this year, mobility has improved further, with visits to restaurants and air traveling increasingly quite rapidly. And you can see on the right-hand side of that slide that mobility in the US is only down now 16% compared to pre-pandemic levels. This increase in mobility is also being reflected in surveys of economic activity, such as the PMIs, with manufacturing activity rising to elevated levels across developed markets and services activity increasing rapidly in the US too. As a result, Euro area GDP probably suffered only a small contraction in Q1, and the US has probably grown by around 7 to 8% on an annualized rate. Now, if we project ourselves into the rest of the year, the outlook looks much brighter. First, with around 400 million doses expected to be delivered in the second quarter in the EU, the pace of vaccinations should take off and allow for the services economy to operate more normally. And on that slide, you can see different things, but the straight lines are the pace of vaccination that you need to achieve to get to 80% or 70% vaccination rate of the adult population by the end of June. And you can see that the US and the UK is done pretty well, while Switzerland and the Euro and the EU has done quite poorly. As I said, now the EU is going to get a lot of new doses in Q2, and if you assume a kind of a steady rate of vaccination, that would allow for a 75% vaccination rate of the adult population by the end of the quarter, if everything goes to plan and everyone who is offered a dose takes it. I mean, this is highly unlikely, but now the lack of supply is no longer an issue for the European vaccination campaign. So that's the first reason for the rising optimism for the euro area. The second reason, and that's broadly for across developed economies, is that generous fiscal transfers and an inability to spend normally have boosted households' savings across advanced economies, as I said. And this is particularly true for the US. And if we move to the next slide, in the US, the government has injected close to a quarter of GDP worth of fiscal support, or will have injected that amount of money by the end of 2021. And in the US, income actually rose much faster than they would have done without the pandemic and the associated fiscal transfers, which also means that savings have increased substantially. And on the left-hand side of that slide, you can see excess savings. So the line is the accumulated excess savings throughout the crisis, and they are now close to $2 trillion dollar. So that's about 10% of GDP, and this doesn't take into account the latest stimulus checks. So it's going to get even higher. As a result, spending particularly on services is likely to increase rapidly over the next few quarters. And indeed, if you look at the right-hand side of that slide, this is retail sales in the US month on month. So that's the bars, and the line is the level, and the dotted line is the trend based on numbers from 2016 to 2019. Well, you can see that spending this quarter in Q1 increased rapidly as the economy reopened and all these stimulus checks came into Americans' bank accounts, and we expect that to continue, especially, as I said, more money is expected to arrive in April in American bank accounts. So, there's one caveat to that, is that a lot of the excess savings sit in richer households' bank accounts. And so you can see from that chart, the bottom 50% of the income distribution doesn't have that much excess savings, but it's really the rest of the income distribution, and you can split that a bit differently, and you can see, and if you do that, you can see there's actually the 20% top end of the income distribution that has accumulated most of the savings. That is, in terms of consumption, this is relevant because richer households have less likely to spend any increase in income. They have a lower propensity to consume. So that means that the US economy will heat up, and we have pretty strong numbers for this year, so close to 7% GDP growth for this year. But we don't think we're going to see runaway inflation. No, we're not going to see runaway inflation in our view. Let me elaborate on the inflation view. This year, base effects will dominate the picture. Commodity prices have bounced back sharply from their trough of March last year, and that's feeding directly into producer prices and headline inflation. A strong demand for some services and goods is also likely to come against bottlenecks in production, leading to some sharper increase in parts of the inflation basket, as we can see in surveys with a lengthening of delivery times. On the left-hand side of that slide, this is the price paid by US producers, both in the manufacturing and non-manufacturing sector, and you can see that leads inflation, consumer inflation, pretty closely. On the right-hand side, you can see that's from a survey from the NFIB, plans to raise prices, and you can see businesses are planning to rise their prices over the next few months, which will feed into, obviously, the inflation numbers that we track. Now, there's that's one thing. So as I said, we're going to see a big bounce in inflation in the next few quarters, and you can see from that chart that we have a peak in the second quarter. So the peak is expected to be around 3% for PCE inflation this year. But then once these base effects start to drop out and more supply come online, inflation should moderate in the second half of the year. And as the Fed has repeatedly said, these are likely to be kind of transitory effects, and we don't expect the Fed to be concerned by these big inflation prints over the next few months. And the key question is, where does inflation go in 2022 and beyond? And I think inflation is much more likely to be at 2% plus than any time in the last 20 years, and that's for three reasons. First, the amount of monetary and fiscal support has been unprecedented, pushing the growth in money supply to historical levels. The second reason is that this support will only be removed very gradually, and monetary and fiscal authorities will continue to work much more closely together. And the Fed explicitly wants to overshoot and will not tighten preemptively. And the third reason is that some of the long-term structural factors that have depressed inflation, such as globalization and weak labor union power, particularly in the US, are likely to go into reverse over the next few years. So that's the view on inflation. And if you move to the next slide here on slide 8, you can see our forecast for growth and inflation for countries that we monitor. So what does it mean for a yields forecast? We see 10-year treasuries at 1.9% at the end of this year and 2.1% by the end of 2022, so only some moderate upside from current levels. One important driver of bond yields is the manufacturing cycle, and in this chart you can see the 12-month change in the ISM versus the 12-month change in treasury yields. And with the ISM reaching 37-year high last month, it's unlikely to rise much further, given that the pace of growth of Chinese industrial sector has been slowing down for several months, and the composition of consumption will shift away from manufactured goods to services as the economy reopens. And if we assume that the manufacturing ISM stays where it is for the next several months, the 12-month change in the ISM will start to drop, and that's the dotted red line here on that chart, which also implies that the upward pressure on bond yields will start to drop. In terms of the composition of bond yields, we think that the increase in yields is most likely to come from real yields than from the inflation component. And on that chart here, you can see the inflation expectations, at least the break-even inflation expectations, or break-even rates, and they have already come a long way since the peak of the crisis. And now they're close to their kind of historical peak. So I would think there's still some upside, but not a huge amount of upside for inflation expectations in the US. Now, market expectations for Fed policy rates, so for future Fed policy rates, have adjusted significantly over the past few months, as you can see from the light blue line, which is the implied Fed policy rate in 3 years' time, and that's close to 1.5%. So a pretty big increase in future hike expectations. And what you can see on the dark blue line, that's the real yield component of treasuries, and that hasn't increased to the same extent. So we think there's still some upside to those real yields over the next few months. So the increase in real rates and therefore bond yields should be moderate, and markets will increasingly adjust to the Fed's new reaction function and will struggle to price more rate hikes in the rate structure. In the euro area, let's move to the next slide. In the euro area, an increase in the pace of vaccination should lead to an acceleration in economic activity, and markets will demand some additional term premium for holding longer dated bonds. And that's why we have also an increase in yields in Germany and in parallel in Switzerland. But for the euro area, the ECB with its PEP program will only allow for moderate increase in long-term bond yields. So we don't think it will be disorderly. So what does it mean for risk assets? Well, we think that they will still do well, but there will be a much tougher and volatile environment than most of last year. One key difference, will be financial conditions. On balance, they will probably tighten, and yields will not go up in a straight line, as the Fed cannot micromanage everything, and we'll have to walk a fine line as we enter a new regime. And for equities, we'll still see some upside at an index level across all regions, although the upside in some cases is quite limited. But we're still constructive on equities, and it relies on two key assumptions. That GDP growth will accelerate, particularly in the US, which should give another boost to earnings. And the second reason, as I mentioned before, is that we think that real yields will only increase, will move up, but only gradually. But what happens beneath the surface will probably play a much bigger role, and being positioned the right way will be crucial. We have been recommending since the end of last year for cyclicals to outperform growth, for the laggards of 2020 to outperform. They've had a stellar performance, and we think that the pro-cyclical rotation has largely run its course, given that the pace of growth in the industrial sector, which has a tight correlation with cyclicals over growth stocks, is unlikely to increase much from current levels. And we think we could be at the cusp of a new phase during which cooling macro drivers become less relevant. While valuations and sector level rationals matter. This may allow some of the more defensive trades that have lost out over the past year to regain territory. This month we have therefore upgraded our recommendation on healthcare and Swiss equities. As you can see from that chart on the left-hand side, healthcare provides an attractive entry point, and the sector should benefit from the reopening of economies, given the large number of treatments and screening which have been postponed due to the pandemic. Within the sector, we prefer European Pharma, which has a significant US exposure, as you can see on the right-hand side of this chart, but does face less of a threat from a potential US corporate tax hike than its US peers. On that slide, you can see the rationale behind our different recommendations. As I said, healthcare has become one of our call for to upgrade. And finally, on that slide, you can see just have a quick summary of our view on the economic outlook and on asset classes. So thank you for listening to the presentation, and hopefully we'll have a good discussion now. Thank you.